the long-awaited Fed pivot has begun. The U.S. Central Bank has reduced its overnight lending rate by 50 basis points, and it looks like it's opening the doors for more to come in 2024 and even into 2025. And here in Canada, the federal Liberal government has come out and it will raise the price cap for insured mortgages from 1 million to 1.5 million and to expand the amortization to 30 years. So lots happening in the United States, lots happening in Canada, and all of it is going to have an impact here on what's happening in Toronto real estate. My name is Ralph Fox. Welcome to the Toronto Real Estate Podcast. I am the co-founder and broker of record of Fox Marin. And today we have joining us a friend of the pod, Jason Friesen, who's a mortgage agent and managing partner at Outline Financial. Jason, so great to have you here on this wonderful, auspicious day where there finally is some good news to talk about when it's related to the Toronto real estate market.
It's weird not to be talking about doom and gloom with interest rates. There's actually positivity, and on top of interest rates, I think trending definitely in the right direction. We've also had mortgage rule changes, which for the first time, I think probably going back almost 20 years, have actually loosened up mortgage guidelines. We've progressively watched mortgage guidelines get tighter, from call it 2006 onward. In mid 2010s, we got the stress test in, reduction in amortization, things like that. So seeing something like this is a pretty big positive change. Is there an election coming or something? Why would all these changes come in now?
In the United States, for sure. I'm not sure here in Canada, but we can only hope.
It's great that the Liberal government announced these changes. There were rumblings that things were going to change for the better. These are substantial changes, if you ask me.
Did you see this coming? Like, it seemed like it just kind of came out of the blue. There was no rumors. There was no rumblings. Just seemed like out of left field.
Yeah, absolutely. This was not something that had been discussed at all. Again, I think if you look back, CMHC, the head of CMHC, I think it was last year, was on record saying they wanted to make sure that they were not adding demand to the market. And it seemed like there would be no changes to anything. So seeing these changes from the government are pretty huge. Why it's important is that $1 million cap on not having 20% down priced a lot of people out of the market in Toronto that wanted to buy a home. I think if you're looking below $1 million for the most part in the city of Toronto proper, at least, there's a high probability you're looking at either a condo or maybe a townhouse. And in some areas, possibility of a house, but capping it at $1 million limited a lot of people and what options were available to them. So seeing it bump up to 1.5, I think opens a door for people to actually find a single family home, whether it be a semi or detached, and it definitely opens up quite a few more doors for a certain subsection of borrower. I think there's a couple considerations. To look at, as it stands today, the minimum down payment on a 1.49999 purchase price is 5% of the first 500,000 and then 10% of any amount above that. So the minimum down payment is 125,000 now under these new CMHC guidelines. Previous to this, you had to put at least 20% down, which was 300,000. So you're talking a pretty significant reduction in the amount of cash you have to have in order to purchase a home. The big consideration, you need almost 300,000 in combined income for a family to be able to qualify for a mortgage at 1.375. So this is not for everyone. I think that's the reality of it, is that it's not going to open the door for everyone. But for borrowers that maybe are, starting out and earlier in their career, have a high income, but just don't have the savings to come up with the 20% plus the closing costs, I think that's the section of borrower that will benefit from this in Toronto. But again, it does require a pretty high combined income to be able to qualify if you were to go up to the maximum and put the minimum down.
A couple things that strike me with this. First of all, having that 1.5 price cap raised across Canada, because, a $1.2 million, $3 million, or even $5 million house in downtown Toronto starts to become a luxury property in most areas outside of big city cores. And so it seems kind of weird that they would do that because supposedly this is trying to help first-time buyers get into the market, whereas it seems like in the rest of Canada, maybe outside of Toronto and Vancouver and Montreal, I guess, you're looking at allowing for people to move into literally luxury properties. What do you think about that?
I honestly, I think, they wanted to just paint it with a broad brushstroke across everything. I think it's much harder to limit specific areas, right? Like what happens, do you make a GTA? What happens if the client's in Burlington? Because 1.5 isn't complete luxury in Burlington. You know what I mean?
I didn't say Burlington.
But where's the cutoff? Is it Toronto proper? What happens if they're in Mississauga? So I can appreciate why they just, made a sweeping change to this across the country.
So people looking for cottages may benefit then. And then the other thing that I find absolutely preposterous is if you look at some of the language coming out of the Liberal government, and it's not a shock to me to find their language ridiculous, this just being another example where they seem to somehow feel that this is supply side and that this is going to help affordability. As somebody who is very active in the market in Toronto, I don't see this in any way helping long-term with affordability, and it probably is going to cause a surge in certain price points in certain categories, definitely in Toronto.
You're adding more demand. That along with the ability for 30-year amortization for first-time home buyers. Typically, the other consideration was on top of being capped at $1 million without the 20%, you were capped at an amortization of 25 years. Now, first-time buyers can go up to 1.5 and they can go with a 30-year versus a 25-year amortization. So it is about a 10%, 9 or 10% decrease in the monthly payments going to 30 years. Obviously, it means you're adding 5 years, you're paying 5 more years of interest. So it will cost you in the long run. But, for people that are really looking at making a purchase, and monthly payment is the key driver for a lot of people, you now have people that are basically able to add 10% to their budget.
Right. And where I see it being a real price accelerator is in that like 2-bedroom, $1.2 million starter home in Leslieville or other parts of the city where it is fiercely competitive and slightly out of reach for certain buyers. It will now open that demand. And I see that unicorn type of first-time buyer property getting pushed up in prices very quickly. And I think that's going to be unfortunate to see because it will push that category of property out of reach for a lot more buyers.
It always seemed and it's anecdotal based on what I'm seeing every day, but that like 900 to 1.2 price point was always super competitive for, again, your starter home, your 2-bedroom, or maybe your small 3-bedroom, and maybe a little outside the core proper. But I feel like it's going to create quite a bit more demand in that area and will likely, obviously I'm not a real estate agent, nor am I able to confidently predict the future, but I feel like that segment of the market is definitely going to have some upward pressure on it.
Absolutely. So that's why when I look at some of the language as to what this is intended to do versus the reality, probably two different things. So I think that's interesting. What are the conversations like? This came out yesterday. What are the conversations you're having with clients? Usually when these sort of announcements come out of nowhere, your phones tend to blow up. What are you hearing and seeing with that?
So not as many calls with clients, but a lot of calls with some of our referral partners. So a lot of realtors are reaching out just to understand the ins and outs in true Liberal government fashion. They were big on ideas, but short on details. So I think we're still waiting for some information to come out to really understand all the finer points. Some of the verbiage wasn't crystal clear as well. So one of the other changes that they made was they've allowed, so you have to be a first-time home buyer to get a 30-year amortization if you're going CMHC.
Yep.
But for new construction, anyone, so first-time buyer or someone that's already purchased in the past, can both take a 30-year amortization. So I think there's, an acknowledgement that there is some pain and pressure on that new construction market. And so this is the Liberal government starting to, put some measures in place to try to make it easier for people to qualify.
And do you see this as being overall a net positive for the market?
In the short term, I think in the long term, anytime you add more demand, especially with interest rates dropping, there's a direct correlation. Rates drop, prices go up, rates, go up, prices go down. So seeing rates start to drop is already at some point going to start to put some upward pressure on the market, add some further demand to that as well. I think it's going to eventually push prices up. And, as we've witnessed in the city here, the possibility it may make home ownership, unattainable for people, or definitely put them in a situation they need to stretch a lot more.
And jumping around here a bit, but investors, there's been a lot of sort of confusion surrounding whether investors, especially in the pre-construction realm, will be able to qualify for this or not. Some are labeling it as potentially being a bailout for the pre-construction industry, with investors having paid prices that are far above the current value of properties, in a way to sort of protect some type of a mass fire sale with new properties coming online. Are you seeing any of that, or what are your thoughts, or do you have any clarification you can add?
I don't have complete clarification. I know that, the wording said, everybody will be eligible for a 30-year mortgage. Keep in mind that the only situation where you can get mortgage insurance is if you're purchasing an owner-occupied property. So I don't think that this will impact investors. I don't see CMHC moving to allow investors to purchase with less than 20% down. So I think it's just a kind of a weird way that it was worded. But I'm sure when they clarify, it's not going to have an impact on investor clients. I think this is only going to end up being for end users. So someone buying a home for themselves or buying a home for their immediate family. So you can still go through CMHC if you're buying a home for an immediate family member to move into. It has to be parent, grandparent, sibling. That's really it. The CMHC second home program. So again, I don't think this will impact investors. And I think I was reading a lot of stuff online today where I think people are clinging to some hope that this will be a lifeline for investors and they'll be allowed to purchase with high ratio mortgage insurance. Unfortunately, I don't see that being the case.
Okay. And let's talk about the U.S. Big news out of the Fed. I think a lot of people were expecting a cut today. There was a lot of bets or debates going on, whether it would be 25 or 50, 50 being a little bit more significant and more of a statement as well. And it came out with the higher number rather than the lower of the two. What are your thoughts on that?
It was a big cut. It was a 0.5% cut. And I think that probably opens the door for the Bank of Canada to be a bit more aggressive. Just looking at what their forecasts are. If I look at what the U.S., they signaled more cuts are coming this year, another 0.5 point in cuts in their final two meetings this year. They envision another 4 cuts next year and 2 in 26. So we're talking another 2% in cuts. So I think that's all positive. Again, anytime we see a reduction in interest rates, obviously, it has a net positive impact on mortgage interest rates, therefore carrying costs. I think, if we look at what this means for consumers on both sides of the border, it obviously helps ease the burden of some of these high payments that people are facing. On top of it, reducing mortgage interest rates, it also reduces interest rates on unsecured debt and on home equity lines of credit. So like a HELOC or just an unsecured line of credit. And I think, been watching, unsecured debt kind of start to creep up both sides of the border. So this will obviously help reduce some of that burden. So there will be a trickle. I think what we'll see is it will end up opening the door for the Bank of Canada to be more aggressive. We'll see what happens. I think we've got October 23rd and then I think it's December 11th. The next two announcements this year could see potentially another 0.5% in cuts in October and potentially another 0.5% cut in December, talking about another 1% reduction. So that would bring Prime's currently at 6.45 to 5.45 for the end of the year. Keeping in mind, before that June cut, we were at 7.2%.
Yeah, amazing. So much for higher for longer.
Yeah, exactly. Now, I think it's also important, a lot of clients reach out and expect, every time we see a 0.25 point cut to the overnight rate and therefore the prime rate, that directly impacts variable rates.
Yes.
I'd say for the most part, fixed rates have priced in these cuts. So I'm not expecting fixed rates to drop another 2%. I think you're looking right now, there's a pretty significant spread between variable rates and fixed rates. A variable rate is always a discount off of the prime. So say you're at a variable rate today, you're around 5.6, 5.7%. Right now, we've got, a 3-year fixed rate close to 4.5%. So a lot of these cuts have already been priced into fixed rates. So again, I think there's this misconception that if we see a quarter point cut on variable, it automatically means we're a quarter point lower on fixed. And, seeing some supersized cuts that weren't expected will push fixed rates down definitely, but it's not going to be, point for point, we're going to see a cut down. I think, there's a possibility we maybe see fixed rates settle in somewhere in the threes by some point next year. But, I think anyone hoping that rates are going down into the twos or threes, I'd be surprised if that happens.
And Jason, can you talk a little bit about the relationship to the Fed versus the Bank of Canada and how it's important that they just reduce their rates and why that opens the doors?
We typically move lockstep. There's only been a couple of times in the last 20 years where the Bank of Canada has moved in advance, either increasing or decreasing rates outside of what the Fed has done. So while we had some runway to cut rates, we were really in a position where even if we wanted to be super aggressive on rate cuts in Canada, unless we had the Fed on board with starting to reduce rates aggressively, there was only so much that we could do. So I think this kind of unties the hands, the possibility that it could end up with weakening our dollar and therefore create potentially inflationary pressure by making imports more expensive.
Correct. Yeah. So this is good news, as you were saying at the top, because it allows the Bank of Canada a lot more room to run. And it's been interesting because our economy has been hurting a lot more than theirs, but we started to see cracks show up. I think a lot of people were shocked when the U.S. revised their unemployment numbers by 850,000 people. That was a big reveal. I think the Japan carry trade tremor that just rocked the financial markets was also really big. And so I think outside of basically NVIDIA stock, the U.S. is in a lot worse condition than most people understood. It forced their hand, especially going into, as you alluded to at the top of this, an election year as well.
My joke was about the election in Canada. I know it's next year, but obviously starting to lay some groundwork there for some goodwill. So listen, I think us as Canadians will take any positive news like this that we can get.
Yeah, it doesn't look like an election's forthcoming this year, unfortunately, for a whole lot of us and viewers watching today.
No.
And Jason, so are you seeing an uptick with all of this news, with rates starting to come down? Like, how are you seeing your conversations with clients?
I think typically the most common product someone would end up taking over the last 20 years, actually probably over the last 30 years, 5-year fixed. I'd probably say at any point in time, 2 out of 3 clients would take a 5-year fixed. Give you the right mix of locking in, but still the ability to renegotiate within a reasonable amount of time. Doesn't really usually make sense to take 10 years. The fear of the penalties if you were to break out of it, and then just the difference in interest being so substantially high, it didn't usually work out to make sense for a 10-year. So 5-year was typically the most common product. I can't say, maybe one client this year, out of all of the clients that I've worked with, has taken a 5-year fixed. Most clients are opting for either shorter term fixed rates. As I mentioned, they're in the mid 4s as of today, or looking at variable rates. And I know we all have, the emotional scars of the prime going up so aggressively over the last couple of years that you'd think more people would be scared of a variable rate. But more clients are looking at a variable rate as not only an opportunity because they think it's going to win and beat out, a 3-year term or a 2-year term over the years you're comparing it to, but more so because of the fact that keep in mind that any variable rate that you secure in Canada will have what's called a conversion feature. So you can at any point in time lock into a fixed rate from a variable rate. So if you think interest rates are going to continue to drop, you take a variable rate today and then 6 months from now lock into a fixed rate, or a year from now lock into a fixed rate if you think rates have bottomed out. So even clients that don't typically like gambling with variable rates are taking the variable rate just so that it basically pushes that decision down the road on when they actually need to take a fixed rate. So they're taking the variable rate fully with the understanding that when they see fixed rates hit a level that they're comfortable with, then at that point they'll go to lock in. I mean, there's risk with doing that. The risk is rates don't move as aggressively as expected, fixed rates don't drop as much as expected, and the current spread between the variable and the fixed being in the fixed rates favor negates any of the interest savings that you may have had by pushing that decision down the road. But clients are definitely, I'd say for the most part, Canadians tend to be more conservative by nature. But clients, I think at this point, after hearing stories of interest rates in the threes and the twos and the ones and things like that, are more willing to take a variable rate with the hopes that they'll end up getting a lower interest rate if they wait a year or wait a year and a half. And I think if you're looking at it right now, we've got lots of clients that are looking to get into the market, just because it does seem like it is. If it's not a buyer's market right now, it definitely feels like it's at least more of a balanced market. So you've got more people that are looking to get in as an opportunity. And I know that we talked about that on the last pod. If you're a borrower that doesn't have a house to sell right now or a condo to sell, you're sitting on some cash and you want to get into the market and you're looking for a home and looking for a little bit less competition than we've witnessed in years past and potentially could be facing in the future. It's not a bad time to buy right now. And, if you're able to, kind of beat the rush, if it looks like that may happen when we see demand increase, but take a variable rate and, take a fixed rate down the road when rates continue to drop, it could potentially put you in a situation where you've actually timed the market and came out on top.
Yeah, I think if you are in the position where you're a buyer and you can be a buyer not contingent on having to sell a property and you have a good budget and covenant, you are the apex predator currently in the Toronto real estate market, which is a great position to be in.
I agree.
Anecdotally speaking, like you tend to, especially on the buy side, see things before we do from a boots on the ground standpoint. The first couple weeks, I mean, we've had overall a very busy year on the buy side, but I find that the first couple weeks of September have been slow, and I'm also seeing it on the listing side in terms of activity on our listings, far slower than we would normally expect during September and in the fall, and also just taking into account more so than I think people realize the weight that the U.S. election does have with maybe people just being distracted or thinking about things other than real estate. So I'm just wondering, like, in terms of activity, in terms of pre-approvals, what are you seeing, and perhaps maybe what do you forecast from an activity standpoint as a harbinger of things to come?
So I've definitely noticed a big uptick. It was sporadic. It would be 1 week would be busy in August and September, the start of September. The next week wouldn't be as busy. The last few weeks have been steadily building and lots of clients are reaching out. Lots of clients are reaching out and inquiring and wanting to put themselves in a position to actually strike versus just maybe poking around and seeing what's going on. They're actually like serious about wanting to get a pre-approval done. Want to make sure that they're putting themselves in a spot so if they see the right place, they're able to jump on it. So I noticed over the course of the last year, it was definitely something where an environment where clients would reach out, they'd be a bit more wishy-washy on how fast it would take them to get back all the application documents. They would, get a pre-approval done, but, kind of look 1 foot in, 1 foot out. I feel like the clients that I've been speaking with at least lately are like 2 feet in, like, let's see if we can do something now before the market gets crazy. This announcement yesterday, I think will probably just continue to fuel that further.
And the announcement today in anticipation of what's to come, especially if you look at what was said.
Absolutely. They gave a pretty good idea of where rates were headed on, what we could expect for further cuts. So, that's puts us in a spot where, the Fed's talking about at least another 2% in cuts. I just expect, Bank of Canada to follow suit somewhere in that range. I'm not obviously an economist, but listening to, we had a presentation with Benjamin Tall today, and his forecast was anywhere between 1.75 and 2% in cuts by the midway point of next year. So that would bring the overnight rates currently at 4.25 to, 2.25 possibly.
Yeah. Wow.
Crazy.
That would have a big impact on the market. I'm a big fan of Benjamin's. I wasn't on that call. What was he saying? Is he giving any sort of prognition for, I guess, the rest of the year or into next year about the market itself?
No, I think there's just overall a concern that the economy is not in great shape. I think that's the message that we've been seeing everywhere.
Yes.
I think one of the other points he was talking about was that, we look at what, where inflation was over the last little while. One third of what was keeping inflation high was mortgage payments, having them increase 25% a year was pretty substantial when you're looking at that, right? So seeing these rates start to come down will obviously ease that burden for Canadians as well. So my forecast is that if it doesn't pick up now, I think it will be a steady ramp up. And who knows? We've had times where December, January are busy. Maybe it's not waiting until the traditional spring market, right? I mean, during COVID, there were periods of time where January and February were insane, right? So, but I do expect that there will be kind of a ramp up of people that are reaching out, and you can only really go up from where the August sales numbers were with Trev, right? So, I think they're the lowest level in 10 years, right? So I'm really curious to see what September looks like, and then obviously see what October looks like after that.
So to the disappointment of some of the YouTube viewers here, you're not betting on any imminent crash in the market?
Not that I'm seeing. And, I think one of the considerations you and I have talked about was, if you're able to do so, these interest rates lowering obviously help. If you've got a condo to sell, I feel like the best thing to do right now is just try to hang on to it and not sell. At some point, it will get absorbed. All of the product will get absorbed, both the pre-con stuff coming on market and the resale stuff. And I know that we were talking about, if you fast forward a couple of years into like 2028 and beyond, with there being so few projects off the ground over the last little while, we're not going to be looking at a lot of new projects coming online. And I think that will potentially create another issue where supply remains the issue.
Exactly. Just zoom out, as I always say. Jason, thank you so much for joining us today on the Toronto Real Estate Podcast. And if you're watching this, it means you successfully made it to the end. And either we didn't bore you or you have a really long attention span, at least in today's world. So thank you so much. Please be sure to hit that like or subscribe button. And if you have any comments and they're constructive, we'd absolutely love to hear from you. On behalf of myself and our real estate brokerage and Jason, thank you so much for joining us, and everybody watching, thank you so much for tuning in.
Thanks, Ralph. Always a pleasure.